You're going to want to do this before they add this new equity tax to your property tax bill. Seriously, this isn't theory anymore. I've been warning about unrealized gains tax here for a while, thinking it was nothing more than, a heads up. But it's here. They've actually been sneaking it under different forms and different names. Let me show you how fast this Trojan horse has quietly infiltrated state constitutions and knocking on the doors of others. Here, look at this. 2022, Massachusetts. Voters approved a brand new 4% surtax on income over $1 million. Overnight, top earners went from paying 5% state income tax to 9% on every dollar above that line, locked into their state constitution. This is not Europe, Massachusetts. Washington just added a special tax on $1 million incomes, called it fairness. California is floating a one-time billionaire tax based on your net worth, not your paycheck, what you own, stuff you've already paid taxes on. New York, Hawaii, Rhode Island, all openly debating their own versions. Different labels, same idea. Elizabeth Warren, Bernie Sanders, AOC want to take this thing nationally. It's like a gas leak. One state lights the match and suddenly everyone's on fire. I mean, if you built something, even if you played by the rules and jumped through their hoops and paid all of their fees along the way, it's not enough. They want a bigger cut and a recurring one. Look, this is how it escalates. First, it was higher income tax on the rich, then special surtaxes on $1 million earners, then exit taxes, mansion taxes, annual property assessments, then one-time taxes on your total worth. This is a tax on more than what you earn. Additionally, it's on what you own too. And once politicians get comfortable taxing net worth, it's a very short walk to taxing your equity, just an additional line item on your property tax bill.
Why is all that home equity just sitting there untaxed? We need an equity tax for fairness.
That's where this is going. And look, a year ago, I was telling you this was a maybe someday problem. I don't think that anymore. Because right now, California has a version of this wealth tax heading to the ballot this November. The way it's written, if it passes, the valuation date is retroactive, meaning they calculate what you owed based on what you owned before the law even passed. The escape window doesn't close when the law passes. It closes when they set the date. And they don't announce the date in advance. They're not trying to be helpful. You can't wait until after the vote to act. By then, the window's already closed. Can they play any dirtier? And by the way, if you think this is just for the rich and that this doesn't impact you, hold on. The first thing we want to do, the simplest action you can take, if you live in Massachusetts, Washington, New York, Rhode Island, Hawaii, and especially California, move. At the very least, you probably want to start thinking about it. The richest, they're already voting with their feet. Elon Musk moved to Tesla out of California. Jeff Bezos left Seattle for Florida. Ken Griffin took his big hedge fund and tax checks out of Chicago. Can you blame him? Griffin has paid more than $1 billion in taxes, and they want more. And here's why Griffin really moved, because his billion wasn't enough for them, because they still couldn't balance the budget. So with him gone, where do you think they look next? The $300,000 you have sitting in your home equity is already tempting them. The number is smaller, but the logic is identical. The Google founders, Larry Page and Sergey Brin, bought homes in Miami. Mark Zuckerberg is joining the move from California to Florida. The rich guys with the best info, they're not waiting. They are getting out while most people still think nothing is wrong. And you might be watching these guys move and thinking, well, good for them. I'm no billionaire, that's their world. Here's why it's not. Pull out your property tax bill. Look at the assessed value line. Your county already knows what your home is worth. They update that number regularly. Sometimes every year. I mean, whatever it is in your county, it's happening more and more frequently nationwide. And they're not guessing at your home's value anymore. They are now using AI-powered aerial scanning, platforms like CoreLogic and EagleView to map your property from above. Every addition, every pool, every outbuilding, every unpermitted improvement, they're finding it all. The assessment system isn't waiting for you to sell. It's watching. It's like Google Street View, except it's working for the IRS. And when your assessment goes up, your bill goes up. You didn't sell, you didn't cash anything out, you didn't touch a thing, but they reassessed you, sent you a bill, and called it fair. That's indirect equity taxation. That already exists. The only debate is whether to add another line and go for a bigger chunk directly. It doesn't seem like it's really a question anymore. I mean, they're just going back and forth trying to figure out how to pitch it to you so you don't revolt. So while they're figuring out their tax the rich marketing campaign, there are some actions you want to consider taking now. If the first one isn't practical, moving, then next you want to consider obscuring the target. Right now, if you Google your own address, your name shows up on the deed. Public record, anyone can see it, including anyone designing a new wealth tax who needs to know what to put on the bill. That's the problem, and it has a solution. Move your deed into a trust or LLC or both. Public county records will then show the entity as the owner, not you personally. The assessed value is still there, but the link between that equity and your personal name, it's severed. An equity tax will be assessed based on individual net worth. If the deed is held in trust, that equity is not in your personal name. It's a different question whether it counts, but it's a harder question to answer. You see, when they're building the database of who owes what, they're matching property records to individual social security numbers. If your name isn't on the deed, you're not in the first sweep. And by the time they figure it out, you've already got your legal defense in place. And tax law has consistently rewarded the prepared. Now, I'm not an attorney, so talk to one. And I've got referrals at protectwhatsmine.com if you need them. Now, I want to be clear about this. Moving your deed is not the same as pretending to move. You cannot just slap a Nevada license plate on your Tesla the night before a bill passes and call yourself a local. State tax boards don't care about your press release. They care about your pattern of life. Now, I've heard horror stories about New York, but I've experienced it personally with California. They'll subpoena cell tower data. They'll vet records, even dental hygienist locations during residency audits. They will literally track your dog's bowel movements to prove you owe them 5%. So if you're going to move, actually move. And if there is any doubt to them that you've moved or not, they will have no problem freezing your bank account and declaring you guilty until you prove yourself innocent. I'm telling you, CA, don't play. Next move, extract it before they tax it. Here's the irony. The people screaming pay off your mortgage are the same people who are going to get the biggest equity tax bill. Your paid off home is a sitting inventory of taxable wealth. Every dollar of equity is visible, quantifiable, and if an equity tax passes, taxable. A HELOC doesn't trigger a taxable event. It's debt. And here's the thing, you don't even have to use it. Just having the HELOC changes your personal balance sheet. Your equity is deployed, not sitting there as an obvious unencumbered target. So talk to a CPA about how that affects your specific situation. Now, if you do pull it out, deploy it into an income-producing asset. Put it to work for you. Equity converted into a rental portfolio is a categorically different conversation than equity sitting in a primary residence. But even an unused HELOC is a shield. This is what the people designing these taxes do with their money. They don't hold it in a paid-off house. They hold it in entities, in leveraged assets, in structures that generate income and carry offsetting debt. All right, 3 more to go. Fight the number. If they're going to use your assessed value as the base for a new tax, the single most important move you can make is ensuring that number is as accurate as possible. In most counties post-AI scanning, the assessed value is just wrong. And it's wrong in the county's favor. Big surprise there. Most homeowners don't know this though. I mean, if you appeal your assessment with comparable sales data, the success rate is over 50% in most jurisdictions. Most people never appeal. They just pay the number the county made up. The government's number is not the real number. It's the number nobody challenged. And if that unchallenged number becomes the base for a new equity tax, you're paying tax on the government's math, not the market's. Now, instead of giving you a bunch of URLs, I put together a short list of everything that I'm doing and the sources that I'm using below for you in the description. So take a look and apply what feels right for you. And if you're thinking I'm being a little dramatic and some of these things may be overkill, well, let me show you how this thing would actually work and why it's not such a stretch. It's simpler than you think because the math, it already exists. Take your assessed value, already on file at your county assessor's office. Subtract your outstanding mortgage balance, already on file with your lender. What's left is your equity. That's the taxable base. They don't need to build anything. They just need one of these bills to pass that says that number is taxable. Now, I can't prove this is coordinated, but I'll tell you what I think is going on. Canada already drew up the blueprint of this model, and Elizabeth Warren liked it so much, she's been citing her version of it on X the last couple of weeks. And her new bill has more than 50 co-sponsors. It's gaining traction. Real traction. And look, the US Treasury has a live published document, the actual title, Advancing Equity Through Tax Reform. It outlines a 25% minimum tax on total income, explicitly including unrealized capital gains for wealthy households. Gains you never realized. Wealth that just sat there growing. Taxable. Guess what's not in there? Unrealized capital losses. Think they're going to give money back if the housing market crashes? Yeah, fat chance. And so right now, they're looking at your home equity the way a dog looks at a dropped slice of pizza, just waiting for the right moment. And here's the part that most people miss. These taxes don't hit you when they pass. They hit you based on what you own on a specific date. Move the day after, doesn't matter. Restructure the week after, too late. The rich, they already understand this, and they're not waiting to find out when that date is. Freeze the assessment. Most states have homestead exemptions that cap how fast your assessed value can grow annually. Florida's Save Our Homes cap can dramatically slow how fast your assessed value rises. California's Prop 13 caps increases at 2% per year. Texas caps at 10%. If an equity tax is indexed to your assessed value, and your assessed value is capped at 2% annual growth while your market value grew 30%, you've already got a built-in defense. But here's the thing. If you haven't filed your homestead exemption, or you let it lapse after a refinance, you've handed the county permission to reassess you at full market value. So go check right now. This one is free. It might already be protecting you, but only if it's active. Another slimy thing that they do, making you renew the exemption that was frozen in time the first time you declared it. Next, convert it. This is the play people designing these taxes use for their own money. For investment property, a 1031 exchange can defer the tax when you move equity into other qualifying real estate without triggering a taxable event. Equity converted into a leveraged, depreciating income-producing asset is categorically different from equity sitting in a primary residence. An equity tax targeting net worth hits assets held in your personal name at full value. A leveraged rental with depreciation offsets has a different taxable profile. This is the same reason billionaires hold their wealth in businesses instead of savings accounts. And it's exactly what real estate is designed to do. Help with that if you need it. It's in that document that I linked below. So what you can do now, 6 moves. Move it, hide it, extract it, fight it, freeze it, convert it. Do at least one of them before this thing passes. In many cases, much earlier than that. Those sneaky bastards with their fine print. After set dates in these bills, the escape hatches get welded shut. And the guy enforcing it doesn't have a sense of humor.
Now if you're thinking, Matt, I don't live in any of those states, and this is only impacting the richest people. This has nothing to do with me.
I get how it might sound that way, but I'm telling you, they're sneaky. It will absolutely impact you sooner than you realize. And I have proof. That's why I pulled this one out here for you to watch next, so you can see how they'll do it, because they've done it before. Yeah, this is no conspiracy stuff. It's a playbook with precedent. All right, I'll see you here. God loves you, and so do I. Take care.